Welcome to My Steel Commodity Flux, the podcast where we track the trends, turns, and turbulence shaping global commodity markets. I'm Nikki Fu, Commercial Director at My Steel Global, responsible for growth strategy across our new business sectors. During July 3rd to 9th, China's LPG market reversed its recent weakness, supported by higher international prices and strengthened domestic demand. But what caught the market's attention wasn't the rebound itself. It was how quickly the market narrative changed. Only days earlier, traders were focused on rising import arrivals and improving supply conditions. Suddenly, attention shifted back to geopolitical tensions in the Middle East, while typhoon disruptions tightened China's domestic spot availability. The question is whether the market was responding to a genuine change in fundamentals or simply repricing short-term risks. Joining us today is Bo, lead LPG analyst at MySteel Oilchem. Bo, if we look beyond the price movement, what do you think the market was actually trading during the week?
I think the market was pricing uncertainty more than shortage. The renewed geopolitical tensions surrounding the Strait of Hormuz immediately lifted crude oil and international LPG prices, strengthening the import costs into China. At the same time, China's LPG market did tighten, but I think it's important to distinguish between temporary disruptions and a structural shift in the market. Refinery output declined because several units were under maintenance, while typhoon disruptions delayed vessel arrivals and unloading operations, particularly in South China. Those factors certainly tightened the spot market, but they didn't fundamentally change the supply picture.
So the market wasn't suddenly seeing much stronger demand. It was facing a tighter supply picture while international costs were moving higher. Let's look at China's domestic balance a little more closely. How did supply and demand evolve during this period?
The supply tightened more noticeably than demand improved. We know that China's domestic LPG refinery output declined because of maintenance, and import arrivals were affected by weather-related disruptions. That reduced the amount of spot cargo available to the market. On the demand side, the picture remained constructive. PDH operating rates continued to recover, supporting propane consumption, while combustion demand remained seasonally soft. So, while demand continued to improve, supply tightened even more, resulting in a tighter market balance. Looking ahead, supply is expected to recover faster than demand, gradually easing the current tightness.
That also explains why inventories moved lower, but refinery inventories and port inventories declined for different reasons, didn't they?
Exactly. Lower refinery inventories reflected stronger sales. Earlier in the week, China's LPG supply was relatively tight, and later, stronger crude prices improved market sentiment, allowing producers to move cargo more smoothly. Port inventories tell a different story. The decline there was driven primarily by logistics. Typhoon disruptions delayed import arrivals, limiting replenishment at terminals, while chemical buyers continued lifting cargoes at a steady pace. In other words, refinery inventories fell because products moved into the market, whereas port inventories fell because part of the supply hadn't arrived yet.
So part of the recent tightness was really a matter of timing rather than a lasting change in supply. If that's the case, what do you think the market will be paying the most attention to from here?
I think the focus will gradually shift back to market fundamentals. The recent rebound was supported by geopolitical tensions and temporary supply disruptions, but those aren't necessarily permanent. As refinery production recovers and delayed cargoes begin arriving, the market will have a clearer picture of actual supply. At that point, the key question won't be whether supply is tight. It'll be whether demand is strong enough to absorb the additional volumes.
So the discussion is likely to move from supply disruption to supply absorption. In other words, the market may continue watching developments in the Middle East, but domestic supply and demand will increasingly determine whether prices can hold their recent gains.
That's true. Geopolitical developments will continue influencing international prices and import costs. But once logistics normalize, China's domestic fundamentals are likely to become the main driver again. That's when we'll find out whether the recent rebound is supported by fundamentals or whether it was mainly a reaction to short-term risks.
Before we wrap up, what's likely to be the market's main focus over the coming week?
I think the market will be balancing two opposing forces. On one hand, stronger crude prices and geopolitical uncertainty should continue lifting international LPG prices and import costs. On the other, China's domestic supply is expected to recover, while demand is improving at a steadier pace, mainly from the petrochemical sector. That suggests prices could edge higher in the near term, but any further gains are likely to be limited unless demand strengthens more meaningfully.
That's very insightful. The rebound reflected a market repricing short-term risks, but whether that strength can be sustained will ultimately depend on how China's LPG market fundamentals evolve. Ibo, thank you for joining us today. And thank you to all our listeners for joining us. If you'd like to follow these developments in more details, the full analysis and data behind today's discussion are available through MySteel Oilchem's latest China LPG market weekly report. For more information, please visit mysteel.net or contact us at inquiries@mysteel.com. Thanks for listening to MySteel Commodity Flux. If you found today's episode helpful, be sure to subscribe for more analysis on global commodity markets. Until next time, keep tracking the flows.